Well, hello again, everyone, and welcome to our latest market report. As always, Dion Zakuski with you here, Branch Manager and Director of Scotia Wealth in Central Alberta. And going back to our last video update in January, we talked about how 2020 should be a pretty good year for investors unless something comes out of left field. Well, guess what happened? A little something called the coronavirus has definitely thrown a curveball into first half expectations. And that's going to be the focus of our report today. First, we're going to check out what's happening out there as it relates to the economy and the stock markets. Second, we'll look at reasons to worry and reasons not to. And finally, and probably most importantly, as investors, what should we do next? So, for what's happening, unless you've been living off the grid for the past 2 months, you've likely heard of the coronavirus, also called COVID-19. And no, this version of the flu has nothing to do with Mexican beer. It's actually an infection of the nose, throat, and lungs. Health Canada has stated that most Canadians are actually at a low risk for this, but this of course depends on your travel plans. Its most dangerous effects are on the elderly who have pre-existing respiratory issues, and the current mortality rate sits at about 2%, which is actually much lower than the previous SARS scare back in 2003. But since the beginning of this virus in China, its rapid spread is now causing concerns for global economic growth. This is why we saw such a rapid drop in stock markets last week, wiping out gains from the past couple months. And do you think the media is jumping all over this? Absolutely. I did a quick Google search of coronavirus stock markets, and it gave me 500 million results. The other day I looked over at the Business Channel and the TV, in a big red banner read, "Deadly virus continues to spread. Dun, dun, dun." So, anyway, not to take away from the human mortality, but from an economic and investing point of view, should we be concerned? Well, this takes us to our next topic, as should we worry, or as my teenagers tell me, Dad, chill out. So first, causes for concern. This mainly has to do with the economic disruption from this health issue. China's economy is the second largest in the world, and if a good portion of it is shut down, then yes, we will see an economic impact. This potentially will have a larger effect than the SARS issue from years ago because China's economy is so much bigger now. Basically, the economic disruption comes from closed factories, which can cause supply chain issues. For example, a company called Foxconn, which operates in Asia, has 1 million workers across 30 factories in mainland China. They've only recently begun to go back to regular shifts. Foxconn, by the way, makes most of the components for a little something called Apple iPhones. The other areas of disruption, of course, would be certain sectors. We just talked about manufacturing, but what about travel and tourism? Impacts on their first quarter for sure. Lastly, and related to this, is consumer spending. And think about it, if you have millions of people who are quarantined, chances are they're not going out to any stores to buy anything anytime soon. But on a more positive note, there are, of course, reasons not to lose sleep over this. First is that if history is any guide, assuming the coronavirus is contained or slowed down, we will see rapid reacceleration to growth. The following is a great chart that will show you that explains further. The chart shows US market performance during various viral outbreaks, measured from when the first case is announced. As we can see, every time there is volatility. However, it was only during the SARS issue, which is the gray line, that markets showed a significant decline, with recovery coming at about the 3.5-month mark. So history is on our side, and there will be recovery. The magic question, is it happening now or when? Well, the simple answer is that a full recovery will happen when investors believe that the pace of new coronavirus cases can be predicted. There's other things we're watching closely too. One is the duration and breadth of this impact. If this drags into April, now we're talking about second quarter and a drag on earnings. Supply chain disruption is another spot to watch closely. And finally, what will central banks do? Earlier this week, we saw both the US and Canada cut interest rates by 50 basis points. In other words, half a percentage point to try and spur on the economy. As far as strategy goes, the big question we get all the time, and our phones have been ringing a little bit more than usual, is what should we do from here? Well, what we can tell you is that because of the pause in labor markets, manufacturing, and consumer spending, especially in Asia, there will be a near-term impact on economic growth. That's just a fact. For how long is the tricky part. Already earlier this week, we saw markets go straight back up, and then straight back down, straight back up again. So recovery will happen, but if we think of it in terms of shapes of letters, will it be like a V? Will it be more like a U? Or choppy, kind of like a W? Regardless, it's precisely during times like these that we own balanced portfolios, owning great investments that don't have much to do with the stock market, such as fixed income, like bonds, real estate, private equity, and so on. These different types of investments will act as shock absorbers in your portfolio that can handle any type of market dislocation. For our current market holdings, our plan is to maintain them at this point, as they are good quality businesses, but obviously to monitor closely. And if this coronavirus continues to go on further than we think, well, we may look to trim back some of those allocations. As investors, we always need to keep in mind why we're invested, along with time horizons. And if you have questions about your strategy or your wealth plan in general, give us a call. It's our job to help you during these volatile times. Thanks for watching, and we'll chat soon.